futures market structure and how money moves. Why market structure matters. Most traders lose money not because they don't know where to enter, but because they don't understand who they're trading against. If you don't understand how the futures market is structured, who participates, who provides liquidity, and who actually moves price, you end up fighting the market instead of flowing with it. In this lesson, I'm going to break down the real structure of the futures market and explain how money actually moves inside it. Not theories, not indicators, but the mechanics that operate beneath every single price movement. Once you understand this, your perspective as a trader will permanently change. The futures market is a centralized ecosystem. One of the biggest advantages of futures trading is that it happens on a centralized exchange. Unlike stocks or Forex, where orders can be fragmented across venues, futures contracts trade through regulated exchanges like the CME Group. This means all buyers and sellers meet in the same place. Prices are transparent. Volume is real. Liquidity is measurable. Every trade you see on your chart is recorded, cleared, and guaranteed by a clearinghouse. This structure removes a massive amount of uncertainty. Professionals love this because it creates fair pricing, reliable execution, and trust in the market itself. The futures market is not a guessing game, it's an auction. The clearinghouse, the invisible backbone. At the center of the futures market is something most traders never think about: the clearinghouse. The clearinghouse acts as the buyer to every seller and the seller to every buyer. This does two critical things. It guarantees every trade. It removes counterparty risk. You don't need to worry about whether the trader on the other side of your trade can pay. The clearinghouse ensures settlement. This is why futures markets are stable even during extreme volatility. Margin requirements, daily settlement, and mark-to-market accounting all exist to protect the system. Professionals trust futures markets because the infrastructure is built for risk containment, not chaos. Who actually participates in futures markets? Now let's talk about who is actually trading futures, because this matters more than most people realize. There are four main participant groups. 1. Hedgers. Hedgers are not trying to make trading profits. They use futures to reduce risk. Examples: airlines hedging fuel prices, farmers locking in crop prices, corporations managing interest rate exposure. Hedgers trade with purpose, not emotion. They create baseline liquidity in the market. 2. Speculators. Speculators are traders seeking profit from price movement. This includes retail traders, prop traders, short-term funds. Speculators take risk so others can reduce it. Without speculators, futures markets wouldn't function efficiently. But here's the key difference. Professional speculators don't guess. They manage risk and exploit inefficiencies. 3. Market makers. Market makers are liquidity providers. They, quote, both buy and sell prices, profit from the bid-ask spread, maintain orderly markets. Market makers don't predict direction. They respond to order flow. When volatility increases, spreads widen. When liquidity increases, spreads tighten. This is why execution changes during news events. 4. Institutions. Institutions are the heavyweights. They trade. Size, structure, time horizons. Retail traders don't have. Institutions don't chase price. They build positions. This creates consolidations, accumulation zones, liquidity grabs. Professionals learn to recognize these behaviors, not fight them. How orders move price. Here's the truth most traders never hear. Price does not move because of indicators. Price moves because aggressive orders consume liquidity. There are two types of orders: passive orders, limits; aggressive orders, markets. When aggressive buyers overwhelm passive sellers, price rises. When aggressive sellers overwhelm buyers, price falls. This is why breakouts occur, stops get triggered, false moves, trap traders. Professionals don't ask, Is RSI overbought? They ask, where is liquidity resting and who is likely to take it? Highs and lows are magnets. Liquidity pools attract volume. Why most retail traders get trapped? Retail traders tend to chase breakouts, enter late oversized positions. Institutions understand this behavior. This is why you often see breakouts that fail sharp reversals, stop runs before real moves. The market is not evil. It's efficient. It moves in ways that transfer money from emotional traders to disciplined ones. Professionals survive by waiting, managing risk, executing plans. The professional perspective. When you understand market structure, you stop personalizing losses. You realize losses are part of the auction. Drawdowns are normal. Survival comes first. Futures markets reward patience, not prediction. They reward traders who understand structure, participants, and liquidity. In the next lesson, we'll break down margin, leverage, and risk control, because understanding market structure is meaningless if you don't know how to survive long enough to benefit from it. This is how professionals think. This is how money moves. And now you're starting to see the market clearly.